Are you having problems making your numbers work on your multifamily real estate? Well, in today's video, Erin and I are going to explain to you some alternative financing options for some construction financing. Check out this video. Hey guys, Josh and Erin back for another Finance Friday, and we're building off of the last video we shot on the macroeconomics of construction finance. We want to dig in today into alternative financing options in the Ontario and Canadian real estate market. Now, when people hear the word alternative, they usually have a negative connotation towards it, but we want to outline what that looks like for construction financing, because that's not always the case, and it definitely has its benefits for the mid to small time developer and investor who's looking to get into some of these decent construction projects in 2024.
Yeah, in today's market, 2023, the end of 2023, going into 2024, construction financing is probably one of the most difficult types of financing to get right now. Cost of materials are high, interest rates are high, margins are low on the outcome. Financing on the back end, if you're looking to hold on to the project, it's all difficult. Everything about construction financing is tough. Money short, all this stuff. So, when we are taking a look at getting, more specifically newer to, intermediate level and experienced investors into construction financing, some of these alternative financing, like our MIC guys, our mortgage investment company guys, these institutional private lenders, are huge assets for us to be able to get these projects done, because they can be a lot more flexible on the lending criteria versus your big bank type guys, your credit unions, your Scotias, your TDs, all that jazz, and also looking into some of the specific CMHC type construction financing, which some of the MICs do offer, but we're taking a look at alternative financing from a different perspective.
Yeah, I think it's important just for everybody to understand the dynamic and the kind of the environment we're in right now. So the big banks essentially froze the majority of construction debt for most developers. If you're one of the big guys, you most likely had your allocation for that year and you were able to get construction financing. But unless you're extremely liquid, you have a massive track record, and you have projects that are already kind of penciled in for that year, the banks shut right down. Like, it was very difficult to get construction financing. And what happened was the people who were essentially bank borrowers dropped down to that alternative financing. So these construction lenders who were primarily dealing with people who couldn't qualify at the bank are now only dealing with or have a massive influx of really great deals to be had. So the amount of capital available for these mid-size or small-size developers who are looking for capital, it's becoming more difficult to be able to do. So having a strong application and understanding how to navigate this type of capital is going to be your best bet when looking to actually take on a project like this in the upcoming year.
Yeah, and I think this goes for not just construction financing, but even the multifamily side. It's the importance of understanding this drip down effect of the tightening of the market, where, like Josh said, these top 8 guys, they're not taking on risk. They have their risk portfolio outlined. They already know who they want to work with and who they don't. They're not taking on guys they're unfamiliar with or struggling to put together capital. They have that debt already outlined. The MICs are picking up on a lot of this stuff, and it really is making it difficult to get newer guys to get their construction financing and multifamily financing. It's tough across the board right now with that drip down effect. So that's why, as we mentioned, we're starting to use these MICs. The MICs offer essentially the exact same, if not sometimes a more competitive construction program versus these A-type lenders. One of the biggest advantages that we get with our MICs is that they tend to do a as completed loan to value type financing versus a loan to cost. So when we compare your loan size, you're getting, in some instances, depending on the loan size, a substantial amount more money if you're lending off of 80% loan to value or 75% loan to value on your as completed value versus 85% loan to cost of just your construction budget, which a lot of these credit unions and big banks tend to use as their underwriting policies.
Yeah, for sure. I think it's important to understand that the strength of the borrowers is still really important when looking to get into these types of loans. So if you're looking to get into this loan, you're probably asking yourself, why would I want to use an alternative lender to begin with? So it's important to understand conventional financing. How does it work? Most people who are looking to get into a small mid-sized project, you're probably going to a credit union if you're under $5 million. The big banks don't necessarily have an appetite for anything under that, and unless you have experience, it's tough to do. So most credit unions will look at a loan to cost perspective. You're probably around 70% if you're looking to build like a project, like a commercial project, multifamily project. So essentially meaning that you have to have at least 30% capital to be able to do the project. Then they're looking at your credit score, have you done it before, your experience, and your ability to actually execute. And unfortunately, most people don't fit those criteria. So what does it look like moving into the next alternative phase? Well, that looks like a loan to value approach in the as complete value. So less capital down, but the downside is it's going to be a little bit more expensive. So right now you're looking at prime plus 2.5 on a conventional lender with a credit union. Most mortgage investment corporations are pricing anything from between prime plus 3 to prime plus 5, depending on location and size of loan and experience. So you do have a significant or a little boost in overall cost of your project. And there is some lender fees associated with actually getting the project done. Now, the advantage of doing this is you're cutting the red tape. If you've ever had to go through a bank financing, construction financing loan, you're very rigid, and there's a lot of red tape involved in being able to actually move into your first tranche of capital. Whereas if you're dealing with a mortgage investment corporation, they have very flexible draw structures. You can choose essentially how this is going to play out. You can have as many or as little as you want. Some lenders have a certain amount of draws based off of per month approach, but most allow for some flexibility and allow you to be able to move through your project without having the same oversight as a normal conventional lender.
I think another big advantage too is how the lender is underwriting the takeout financing. If you're looking to build, to rent out, when you go to an A lender or a credit union, they're going to limit that loan to cost based off of your ability to take that financing out probably 90% of the time without underwriting from a CMHC perspective, even if your goal is to refinance into CMHC. The credit unions, their risk appetite slightly less. They want to make sure that worst case scenario, you're going to be able to refinance this property into their own debt because they do have that first right of refusal on the project. When we take this to a mortgage investment company, they're a lot more flexible on the understanding of the end goal and the exit of the project. If we explain to them that, hey, this project's going to be going into CMHC, we're underwriting this at, right now 4.85% based off of 1.1 debt servicing. We're going to be using affordability or energy efficiency. They're going to work with us to allow that exit and be a lot more flexible, which is going to keep you or allow you to keep that loan size a lot higher than what you would be when you're limited to underwriting at a credit union, when they're taking a look at the exit on a refinance at 6.9% with a 25-year AM and a 1.2 debt servicing. So again, even just like the structure and the understanding of how the deal is going to be transitioning out and their ability to work with us is a substantial benefit versus being restricted to your exit financing.
And that's probably the main reason why we see people go to the mortgage investment corporation side, because the cost of capital means less than the amount of equity they need to inject in the project. And for people who are looking to run these numbers, it's a significant difference because you're limited by the takeout on conventional financing versus the takeout on something that has possibly a 50-year amortization, 95% loan to value on the back end or cost on the back end. The amount of capital required to get into this project doesn't necessarily offset the cost if you're in it for such a short period of time. And we're seeing most investors who are looking to get into these smaller projects, they care more about the capital out than they do the total cost. They'd rather have a little bit less profit or a little bit more capital in the deal at the end of the project than have massive costs up front to get in. And most people are seeing, and we're seeing a massive trend towards people looking at getting into these types of loans.
Yeah, and I think when you take a look at why investors are so focused on the equity takeout in today's market, when liquidity is bone dry, there's a lot of prom notes, there's a lot of private money going into these. The exit and the ability to pay back these private investors is obviously paramount, and keeping your relationships first and foremost, and ability to recycle that debt. If you can't pay back your investors, it crumbles that relationship. So to be able to have a lender that's going to give you more loans, which means you have to borrow less, and it's going to allow you to expedite that refinance that much quicker, means you're getting more money back to your lenders at a much quicker pace, and you're able to pay them back. So again, like the product that we're pushing out fits kind of the environment of the economy right now and what we're seeing investors use to be able to put this money together. Obviously, if you have all your own capital and it's all your own liquidity, there's less concern on how quickly you can expedite how much money you get to take out versus paying back private investors.
Yeah, and something to keep in mind is just like the regulatory environment that we're in right now. CMHC changed some rules on the multifamily side, but that doesn't necessarily pertain to actually paying out construction debt. So this is still a really viable option to be able to move your project along. So if you guys had any questions in regards to the previous rules that happened, you can still use non-NHA approved lenders to be able to use your construction or get construction financing and then pay it with CMHC still. Most developers are using this strategy to save time and to be able to exit their projects on time.
Yeah, and I think it's important to note, like when we're talking about ground up construction, or we are talking about ground up construction, not necessarily conversions. And if your four walls are standing, CMHC probably isn't going to recognize that as a construction. So we're talking about raw land ground up type construction. You can use a non-NHA and still be able to exit into CMHC.
Yeah, taking a look at future outlook and opportunities, what is going to happen in 2024? I think you're going to see just a massive push towards people continuing to dive deeper into these products. I think there's a handful of mortgage investment corporations who are in the market, who are doubling down on it, who are offering this mid-tier, $1 to $5 million construction. And the capital markets aren't going to just loosen up on a dime. I think it's going to take some time, and 2024 is still going to require that mid-sized to smaller investors who are looking to get into these projects are going to need to look at alternative financing to be able to move the projects along. Yeah,
I think the drip down effect is going to maintain itself through 2024. I mean, we all see the news on developments going up in flames. That's a direct reflection to banks' insurance policies and their risk tolerance and who are they going to be lending money to, and liquidity crunches and net worth and ability to get it done. So I think even as rates come back down and the costs come back down, lenders are going to be aware of an increase in mid-level investors that want to get in the construction side. And when you got larger developments from guys with proven history and these projects are catching fire, however it's happening, that is going to trickle down. So, I think we're going to see a little bit of a prolonged effect on the construction side, development side, and the alternative lenders are going to have a huge part to play moving forwards.
A definite advantage. If you guys enjoyed the content that we created today, we really appreciate it if you hit the like button, hit the subscribe button on our video. If you have any questions about specifics around your project, Aaron and I are always available. Our contact information is going to be down below. I really appreciate everybody watching. Again, if you have any questions, reach out. We're happy to help.